It's been a perfect storm for investors around the world. Inflation at 4-decade highs in major economies, interest rates on the rise, with more hikes to come, and fears of recession as businesses and consumers brace themselves for more bad news. Given such volatility, does it make sense for new investors to put fresh money into the markets?
Bear markets never last forever. Eventually all storms come to an end, and there's usually a sunlight, at the end of the storm. So investors have to look beyond just the immediate term. They have to look out into the medium to long term. Secondly, bear markets result in prices of stocks pulling back sharply in most instances, right? And that in turn results in, valuations getting more attractive. It creates a buying opportunity for investors.
During market downturns, defensive stocks have tended to be more recession-proof.
When we did an analysis of the S&P 500 in terms of sectors, we have observed that defensive equity sectors such as healthcare and staples tend to outperform before and after a recession. On top of that, treasuries and gold could serve as a useful hedge against a recession because they tend to outperform and benefit from a flight to safety. But as for cash flow, we will still continue to look to generate stable income through dividend income plays, and this could include selected telecom stocks or even Singapore REITs. And within the credit space, we have actually stated a preference for investment grade credit, which will provide a more defensive carry over high yield bonds, which tend to be more vulnerable in a downturn.
What we advocate is to find companies, at least for us in Singapore, will be companies that have attractive valuations, strong balance sheets, and healthy dividend yields. And we just let the economics of the business carry the share price. The other thing is just that for investors, timing is a challenge. So we recommend investors to better to just size your position as you enter the market. Always remember too, in the near term, the market is like a social game, reliant on strangers. So in the near term, strangers may not agree with your view, but longer term, if you are buying into strong fundamentals of a company, eventually the share price should reflect these fundamentals.
With uncertainties continuing to play out in the markets, investors are advised to practice both asset and time diversification.
I think the first thing here is it's very important to understand one's risk preference and ability and position your portfolio accordingly. So for instance, if you are someone who is rather risk adverse, you would really want to actually shy away from higher beta volatile investments during these times because it will help you to sleep better at night. But I think more importantly, diversify. I think diversification is really the key here to help one mitigate the downside risk when it comes to the investment portfolio.
Let's say if you had $100 to invest, I would try to invest through the dip rather than trying to find and pick the exact dip. So $100, I would invest $20 today, maybe $20 in 3 weeks, and then $20 every three weeks after that. It's going to be up and down from here. It's going to remain volatile. There's a lot of uncertainty. You cannot pick the bottom, but if you invest through the bottom, you will not miss the bottom. And the thing is, once the certainty comes back to the market and gets priced in, it is oftentimes too late, and you would have missed on this opportunity of a bear market.
Given the headwinds, there could be a temptation to sell off. But experts say this may not be an optimal solution in the long term.
For a lot of people who are starting to invest, the idea of loss is probably number one. Especially, and this is a bit of a generalization, but especially in Asia, we are very conservative in general. We are very conservative. And as a result, participation in the markets investing towards long-term wealth are generally lower than in other parts of the world.
There is a risk of selling everything out and parking into cash. I think one point to note is that many investors who sell during a downturn tend to miss out on the eventual market recovery. And once they miss that market turn, they actually tend to remain underinvested and hold too much cash, which will have a negative impact on the long-term returns.